Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets.
My name is Joann, European rate strategist, and I'm joined today by our global market specialists, Paul Robson and Stuart Sparks. An interesting week in markets this week, and it's not really been the US as the prime suspect and driver of rates for most of this week. So I think for this week's episode, we're going to touch a little bit on Japan and what moves we've seen there, as well as the implications that has had on global rates markets. For some context, we have had a bit of a volatile session on Tuesday with the Japanese Ministry of Finance essentially thinking about whether they should be shrinking issuance in the JGB market. And that's really been a result of soft auctions last week in the 20-year, and another one this week as well with the 40-year as well. So we had a pretty impressive flattening of the curve on Tuesday morning. Paul, let's start with you in the UK. Do you think that there are implications for the UK and the UK curve from this?
Yeah, it's very interesting, isn't it? The DMO here in the UK is, sorry about the pun, but seems to be, further along the curve than some other DMOs. So I think they recognise the shift in demand against a really quite significant supply, a negative backdrop, and so they have reacted. I don't think the flattening that we've seen elsewhere really is set to continue here in the UK, even though we have had that shift in supply from the DMO in the UK. I think the outlook for gilts just generally feels bearish. I think it's bearish outright. I think it's bearish on a cross-market basis. I think the higher yields just generally that we've seen globally in the last couple of weeks, I think it just shines a light on some of the fiscal sort of vulnerabilities here in the UK. Obviously, we have a very large debt stock. We have borrowing continuing to rise. We've got weak nominal growth, and we've got high funding costs. And that combination, I think, when markets worry about the long end of the curve and fiscal policy, one of the places they come to quite quickly is the UK. Obviously, regular listeners will know that we've been concerned about the sort of fiscal position here in the UK. We think that investors have been somewhat complacent. Maybe they're less complacent than they were. But I think a lot of people hide behind the government's fiscal rules as comfort that once you get 4.5, 4.75 in the 10-year, that might be a good entry level for to buy gilts. But those rules obviously can move around. The government came in, they changed the fiscal rules. It looks like they'll have to tweak them again at some point. And while that might satisfy someone like the IMF, for example, who was talking about it this week, those bonds still have to be issued, and that's clearly important. Recent borrowing data continue to overshoot. Yes, receipts are higher, but so is spending, and it doesn't feel like you're getting any sort of consolidation within government borrowing, and I think that's a risk internationally. Now, as your question suggested, the DMO realizes that against this sort of heavy supply, demand is shifting. Lots of people have talked about pension fund demand, and of course central banks just globally are no longer buying government bonds. The QT they're selling down. But I think it's really interesting, even though the DMO has cut the longs bucket here in the UK from 30% of overall issuance to just 10%, because the overall amount of issuance is so much larger than it was pre the pandemic, you're still getting the same nominal supply of long end bonds, so 30 billion a year. And then given the demand backdrop is dramatically different, I mentioned the Bank of England, the pension funds. So I still think that's enough to keep the long end of the curve really quite elevated. And I wouldn't be surprised if gilts, the 10-year at least, sort of stay in the sort of 4.75 to 5 through the second half of the year.
Thanks, Paul. So, Stuart, on the US side, do you think that a shift in the issuance schedule similar to Japan could be considered there? What is your curve view at this point going forward?
Yeah, I mean, Japan did impact the U.S. market, and the reason I think is that ultimately this is a demographic issue, and the demographic circumstances are quite similar across major industrialized economies. Japan, perhaps foremost, but the issue here is the aging of the workforce. So this is the graying of the baby boomer generation, and that manifests itself in support ratios. So there are fewer people working, paying into the system, relative to a larger cohort of people receiving benefits from the system, and that imbalance necessitates borrowing. So what this, ultimately this is about fiscal policy very clearly. And the long and weakness, in our view, reflects an increase in the market probability of a soft default here. So, as opposed to a hard default, which would mean in nominal terms, but rather we're talking about in real terms. Put simply, markets dynamically, assess the probability of debt being repaid by future surpluses, or, in contrast, potentially being monetized. And as there are challenges with respect to potential growth, the markets are concerned that ultimately debt dynamics could potentially become unstable or explosive. And for that reason, you could interpret Fed policy more oriented towards growth and less oriented towards inflation as a choice to, in a greater proportion, monetize the current stock of debt vis-a-vis repay it through contractionary fiscal policy, i.e. running surpluses. So that's what we think is going on. And we think it's in one way or another sort of common, again, to the major industrialized economies. And so the next question is the curve behavior, or how to interpret the curve behavior. I think the first way is quite rational, and that is we have fiscal problems, we have an inflation problem. These are higher risk premia that are warranted. And in that sense, I think the Fed will be unconcerned until such point as that term premium becomes disruptive, i.e. you could think of this just as a discounting problem for a given earnings stream. And that's not considering sort of feedback effects into the economy and the level of earnings. So at the very least, for a given set of earnings, if you have higher long treasury yields, it creates a negative shock to risk asset values, equities, corporate credit, et cetera, et cetera. So to the extent that higher term premia are not disruptive, the Fed tolerates them. If they become disruptive, then you could potentially see some sort of intervention, potentially from the Fed, potentially from the Treasury. I would expect it to come from the Fed. Is in that situation, it would be sort of an exigency. It would be sort of maintaining market function. And as there are sort of two tiers of interpretation, I think there are two tiers of policy response. The first one, and the one that we've been speaking most and writing most about, is simply defending the inflation mandate. So this would reassure the market that the probability of ultimately monetizing a greater proportion of debt remains small, and that the commitment is there ultimately, as the political cycle and as the growth cycle permits, to run surpluses and pay down the debt. So that would be a sort of normal course of Fed reaction. We think that implies at least doing nothing with respect to short rates, so not cutting by year end, and indeed not cutting into the end of the Powell term as chair, which runs through about this time next year. And that is, I think, I think our argument has been that this would have substantial impact both on inflation expectations, both on foreign sponsorship of the long end. This would alleviate pressure on dealer balance sheet and reduce the liquidity premia, et cetera, et cetera. And then for the second tier, the second interpretation, the response would be targeting preserving market function. And in this sort of situation, you would think of some sterilized interventions, perhaps a Operation Twist type thing, if it became necessary to stabilize the long end, to preserve or to prevent an unwarranted or an undesirable tightening of financial conditions. So, I mean, we have come down on the easy way out for the Fed being to simply tack its colors to the mast on the inflation mandate. In this instance, that's driving our view, our bearish view relative to the short end forwards, and our view of a slowly but cyclically slowing economy still leaves us to expect a twist, which is even from current levels bearish for the front end, and actually bullish from the long end. And of course, the issues that need to be resolved for that latter part to manifest itself, are ultimately the spending agreement, but I think more importantly, the Fed's monetary response, and the ultimate issue. Again, we think the keystone issue for policy is defense of the inflation mandate.
Yeah, all very interesting, Stuart. Maybe I can turn the tables on you, Joann. I know that you've liked steepeners in Europe for some time. I was just wondering if anything has changed for you. And also, do you think European DMOs will sort of take a look at the UK, look at Japan and start shifting as well?
So I guess the short answer on the steepener is no. I still do like the steepener. I think everyone knows that we've liked steepener for a very long time now. But I think that a couple of things make me still want to be in the steepener. The first, I think, is when we think about Japan, the reason why demand has been low there is a very Japanese-centric issue, given that it's a shift in insurance demand, which has been driven by capital regulation. And of course, we've had soft auctions in Japan as well. In Europe, I think that we've not really seen the same market instability or market volatility driven by supply, at least in the near term. So I think it's a bit too early for European DMOs to necessarily shift things too much. The weighted average maturity of debt coming from the top 4 issuers in Europe has been pretty stable the last few years, and I don't think that there's a big push at this point to shift issuance down the curve. I think, of course, that comes with other risks such as interest rate risks and credit issues as well, if that is the case. The second point to note, I think, is very similar to what you said, Paul, on the UK side, which is essentially that in a period of high and elevated supply, moving the buckets around only risks really flooding other buckets of issuance. So you can argue that, there might be much more demand at the shorter points of the curve. But if we just have overall higher issuance levels across the curve, you do risk actually over flooding certain sectors. So again, I don't really think that's an area being considered at the moment, given that there is pretty high European supply. And I think that in Germany, of course, there are questions around what spending could look like next year. But to me, that risk is still to the upside. The last point to mention on this, and in regard to the Japan's shift, is, I suppose, the Dutch pension fund transition. Now, I think that this could probably be what happens eventually in Europe when the pension fund risks become more pertinent. There's obviously a move away from the long end of the curve because Dutch pension funds are going to be using a defined contribution model versus a defined benefit model. And with that will bring lower demand for long end issuance. So again, I think that this might be something we come back to when there is a financial stability concern or more of a market bubble. But I think at this point in time, it's still very much wait and see on those topics in Europe versus a need to do anything too quickly right now. For now, I think the steepener does make sense. We still have high fiscal policy. We still have that term premium trade that should be working. And supply risks to me are still skewed to the upside here.
Yeah, so it sounds like the way forward is steepeners both here in the UK and in the rest of Europe. I guess there's probably not a podcast in the world that doesn't ultimately have to cover the big T word. So tariffs, obviously we've been a few developments. Some of that was focused very much on Europe. I was just wondering what you made of it all, and does it actually change anything in terms of your thinking?
Yeah, so the tariff narrative has shifted already quite a lot in the last week, with EU tariffs moving now from the 1st of June to the 9th of July. So it's really giving the EU some more time before that 50% tariff does come in, if it does. I think the one thing that stood out was the fact that European leaders over the weekend did seem to be much more keen to speed things up. As we know, Europe has been a bit of a bit more on the back burner when it comes to trade deals. So maybe the threat was what Europe needed to try and push something forward. I think that on our side, we continue to think that Europe does have lots of tools available that they can use to leverage a deal with the US. They've got, for example, the anti-coercion tool, and they've also got the fact that there is a services surplus with the US, which means that they can essentially target US services that they need. So it does seem to me that there is enough leverage on the European side that some sort of deal can be found between Europe and the US. So there's obviously also been a pushback on reciprocal tariffs in the US. Our colleague Brian Dangerfield does cover this more in detail, but I think that we're really not out of the woods yet when it comes to tariffs. Trump could actually come in and try and push back on the ruling here, or could pivot to other options. Section 301 is obviously quite important in this regard because it does cover the Euro area and China as well. So I think for me, tariffs are still very much a wait and see topic, but we do think that hopefully there will be some resolution here going forward, and that should be to the benefit of European growth as well.
Yeah, it certainly has been another week of sort of ebbing and flowing in terms of tariffs. I was actually recalling the children's nursery rhyme, the old Grand Duke of York, march soldiers to the top of the hill and march them back down again. And it feels like we're going through those cycles, and it'll be interesting to see where we settle down and ultimately how that impacts the sort of medium-term outlook. In terms of that medium-term outlook, that will be something that the ECB will be thinking about next week. So what are you thinking in terms of the policy change, if we get one, and also going forward?
So, I mean, it's pretty interesting how much the market's changed, right? I think not too long ago, we were debating whether or not the ECB would even be cutting in June. And clearly that's completely priced in now. 25 basis points is essentially fully priced in and done for next week. And the key now is what will happen going forward, I think. And our base case is that the ECB lands at 2% and lands next week, essentially. And that's based on a few different factors, mostly surrounding how we see growth, I think, versus the market. I think, firstly, the GDP numbers in Q1 have already come in a bit better than expected, which sets us in a positive light for the rest of the year. I think the second thing to know, of course, is that without clarity on tariffs, it's a bit difficult to have a strong conviction in your view on growth, right? I think if you look at various research, if we do get a 10 to 20% tariff, for example, it's not really going to be very impactful in terms of European growth. But if we get a scenario where there's an escalation of tariffs, there's an escalation from the European side as well, that could have much more significant implications. So I think that for us, we have to have more clarity on what really the growth outlook will look like for the next year based on what happens with tariffs. So I think it's a bit too soon for us to be changing our ECB call, which has been 2% for a very long time now. I guess the last risk to know as well is just a positive risk, I would say here, in the sense that German spending plans are something we've been talking about for quite a while. And there's still not very much information on what that will entail. The 25th of June is a date that we're watching just because we could have a proposal for the 2025 budget coming in there. And that could give us a better indication of what the spending plans will be. And if Germany is able to spend, I think that comes with it a positive risk to growth, where growth would actually surprise to the upside versus our expectations here. So that's definitely something in the pipeline that we need to be watching. And of course, we continue to watch the consumer side of the economy as well to see if disposable income dynamics can support growth here as well. So I think overall, our assessment of growth is more positive, I would say, than the rest. And I think the big question mark is on tariffs. And in this scenario, we think it makes more sense for the ECB to essentially stop cutting at 2% versus taking rates below and towards the lower range of their neutral range target at 175 to 225%. For next week, I think, aside from markets trying to gauge, whether there will be a cut in September or not, given that September is where more cuts are priced in relative to the rest of the year. I think they'll also be focused on the forecast coming through. It is a projections meeting. Over here, we do expect growth to be revised up a little bit and inflation to be revised down a little bit. I think there's obviously been lower energy prices in the last few weeks that can help the inflation picture. We've got the French regional inflation prints this week as well, which suggested some downside surprise for May's print. So I think that in terms of inflation in the euro area, we really aren't very concerned about it. It's very much a normalization process, and the data seems to be following through quite nicely. We're just a bit more positive on growth, and we think that will be reflected in the forecast. Lastly, to note, on the market side of things, I do think that given the uncertainty in the outlook, even though we do have that 2% target, I do expect that one-year rates will continue to be below our 2% target. And I do expect that the market will continue to price in some risks of extra cuts through the year, just because there's a lot of uncertainty. So we do need that uncertainty complex to become a bit more clear for that pricing to shift materially. But I think for now, it's really trying to gauge what we see from the data and tariffs to really get a better view on whether the ECB goes one more time or it does stop with our 2% target. But that's it for me for today. Thank you, everyone, for joining me. Thank you, Paul and Stuart, for speaking on the podcast this week. If you did like this week's episode, please don't forget to like and follow as well. Speak next week.